Hey guys, this is Ryan with TrendLizard.com. I hope you're doing well. We've used this slot over the last few weeks to look at the hottest things that are going on in the market. That has been looking at a few pot stocks, looking at Amazon, looking at some different things out there. I think the hottest thing that's going on in the market right now is the market. The market's been going crazy. It's been tanking in October. It's been pretty scary for a lot of people wondering if the bull market is over, and that's a legitimate concern because it does look like the bull market is getting closer to a major high, and that's obviously something you want to be aware of. Obviously, it's fun to pick stocks, but really at the end of the day, the most important thing is what is the overall market doing. About 80% or more of the stocks that are out there are going to follow what the overall market's doing. So there's no point in trying to swim upstream. We want to be in sync with the market. That's a lot of what our focus is at TrendLizard.com, and our analysis is just seeing what the overall market's doing and understanding if it's a good time to buy or if it's a time to wait and let the market do its thing and then focus on stocks when market lows occur. So that's kind of what we're going to do today. We're going to take a tour of several different charts, look at the market from a ton of different angles, and understand if the probabilities are in favor of the bull market ending here as October's decline builds, and if that left behind a major high, or if the bull market has not yet run its course. So that's the game plan today. I'm going to look at a bunch of charts. Sorry if it's a little bit long, but I think it's a super important video, and it gives you a look at some of the things that we look at from a day-to-day basis and some of the things that you can rip off from me, frankly, if you want to look at some of these indicators or different things and understand what our approach is to understanding how's the market doing overall and if the probabilities favor, again, a bear market high or a continuation of the bull market. So that's the game plan today. Get comfortable. We're going to dive in and see what the charts have to say. Here we go. All right, guys. So the purpose of what we're doing here is we want to answer one question. Are the probabilities in favor of the bull market ending here, or are the probabilities in favor of the bull market continuing from here? And we're not wanting to look at the same thing in 20 different ways. We're not trying to look at 10 different indicators that basically show the same thing. We want to look at as many things as possible and understand where the probabilities lie. Anytime we're dealing with the stock market, we're dealing with probabilities. We want to see if they're in our favor or against us, and that's the best we can ever do. So we're going to go through the charts here, look at 10 different things that showed very different indications, and see if there's a good chance that the bull market is over or if the bull market is still in progress. So I'm starting here with a very long-term chart of the the SPY, which is the S&P 500 ETF. We know that it's been in a huge bull market off the 2009 low. As you can see here, that advance off the 2009 low is one big five-wave move. Now, we know when five-wave moves complete, that's the end of the move, and then we see a very massive move in the other direction. So in this case, when this five-wave move completes here, we know we're going to get a very large three-wave pullback that'll probably last several months, years, things like that. Here's an example of a very large three-wave pullback. I don't know if we're lining up for something similar. I don't think so, but nevertheless, the stakes are very high because when this five-wave advance does complete, we know that a major pullback is coming. So let's go ahead and dive in a little bit and see if it looks like the five-wave advance is over. First off, let's go ahead and zoom in on what's happened in 2018. This looks at the pullback off the January 2018 high. When we analyze it with Elliott wave, it looks like a counter-trend three-wave move. So that's a bullish thing. That's the first suggestion that the bull market is not over, because if the pullback is a counter-trend move, that necessarily means that a new downtrend has not begun. One of the other interesting things about this chart here is you can see the down leg that played out in early 2018 excuse me, is identical to the size of the current pullback. They both played out in 33-point moves. So that's a good sign as a first step that the bull market is not over and that higher prices are coming. So let's go ahead and look at another chart. This is the triple Qs. This is the Nasdaq Etf. It's looking at the advance off the 2015 low. And when we dive in and take a close look, we can see that it's a five-wave move that's not yet over. So it looks like we are in the fourth wave. So it is true that it does seem like we're getting closer and closer to a very important high, but it does not look like it's there yet. This October pullback looks like a fourth wave pullback, not the end of the bull market. So that's another good sign. So how about this? Let's take a look at a sector. So if we look at XLF, this is the financials ETF. Again, we look at the 2018 pullback and it looks like a counter trend move, just like we looked at with SPY. You can see the chop here that's happened. It went sideways for 9 months before breaking down in October. The initial down leg was a 3-wave move. These are all indications that this pullback that's been going on here is not the start of a new bear market. How about global markets? If we take a look at global markets, we find a very similar thing. If we look at the 2018 pullback, we see that the initial down leg in early 2018 is a 3-wave move. We know that 3-wave moves are counter trend moves. And then if we look at the overall pullback, we see that it's also a 3-wave move. So again, these are all indications that suggest the probabilities favor that a major bull market high is not yet in. Let's dive into one of the leading stocks that's led the way to the upside. This is Amazon. You can see the advance off its 2016 low. It's in a 5-wave move. And again, like we looked at the triple Qs earlier, it looks like it is in a 4th wave pullback that's going to lead to another big advance. You can see like the first wave here lasted maybe 9 or 10 months. This move here lasted a couple years. So another 5th wave up might last something similar to that. So again, it does not look like the bull market high is in. We're looking at it from every different angle, looking at different things and seeing where the probabilities lie. So that's the price action. What if we look at some of the potent technical indicators out there that provide insight into whether a high is going to happen or not? Let's do that. This is a look at the advanced decline ratio. So basically, it's a little bit confusing of a chart visually. But this blue line here shows the advanced decline ratio. It's just a ratio of how many stocks are going up versus how many are going down on a daily basis, and then it plots it on this blue chart here. On the bottom line here, you see the Nasdaq. This is just the price action of the Nasdaq. Now, whenever we see a sharp spike down, which means there's more declining issues than advancing issues, you get these spikes down. These don't happen very often. This chart goes back to 2008. You can see there's 5 other instances over the past 10 years that the advanced decline ratio has spiked lower here, like these spikes here. And if you follow the green lines down where these spikes lower in the advanced decline ratio occurred, you can see that they tend to occur near market lows. It may not be exactly on the low. You can see here the spike occurred before the actual low happened in 2016, but they're often very close to market lows. We have another spike down that's happening currently, and it's a sign that a market low appears to be brewing. Let's look at another indicator. This is the put to call ratio. Now this shows the number of puts that are being bought, which are bearish bets on the market, versus the number of calls that are being bought, which are bullish bets on the market. Now, whenever this spikes higher, it's an indication that bearish sentiment is on the rise, and it's almost at a capitulative point where there's just too much bearish sentiment, and that's actually a bullish thing for the market. So you can see this dates back to 2014. There's just been a handful of times that the put to call ratio has spiked as high as it's spiking right now. And you can see when those spikes occur, you follow the green lines down to this price chart of the S&P 500, and you can see that they sync up with market lows pretty darn closely. So this is another indication that an important low appears to be nearing, and it's another sign that the probabilities are favoring a continuation of the bull market before we get there. I got one more indicator for you. This shows the standard deviation. So basically the top red line shows the Dow Industrial Average and its price movement. Now this lower line shows the standard deviation, this black line here. Whenever price goes from a very tight range to very big days where we're getting huge moves day after day, we get these spikes that happen. And again, you can see they're very few and far between. This dates back to 1999. We have like 8 or so spikes that have occurred over that time. When these spikes occur, again, they tend to sync up with market lows. So you can see a spike here. That was a pretty important low. A spike here and a pretty important low. It syncs up pretty darn well. The one time it didn't sync up super well was at the 2009 low. It took about 5 months, but after that, it did put in an important low. So it kind of gives you a perspective that when this thing spikes higher, it tends to lead to important market lows. So I've got one more angle to look at here. This may look a lot like a chart that we started with. I think this chart here, you can see it looks almost identical. This chart here shows what's going on currently. This chart here shows what happened in 2015. You can see that it had an A wave down, it had a B wave up that set a new high above the A wave high, and then a big breakdown that took place. So that's what's happening again here. Big down, A wave, a B wave that set a new high, and then a tank job like what's going on right now. So as you can see back in 2015, what happened is after the spike lower, you had a really strong recovery from about 1880 up to 2100. and shortly thereafter, it left behind the important 2016 low. So again, hey, we're just looking at it every different direction, trying to see if the probabilities favor at the start of a bear market or if the bull market is still going. And from what we're seeing, we looked at it 10 different ways with the charts that we toured here, and it just doesn't look like a high is in at this time. So I think you need to remain bullish. Certainly we might see a bit more weakness before the low is in, but I don't think it's going to be too long before you see a nice recovery. We'll see if it's as sharp as the one that happened off the 2015 low, but that's what we're looking at. And so in our point of view from Elliott Wave and from a technical indicator perspective, it does not look like the bull market is over. I think you need to remain bullish in the long term and expect higher prices. So again, this is Ryan with TrendLizard.com. I hope that's helpful. We use these charts every day. We take a look at the market from every angle and make sure the probabilities are always in our favor. We've been in cash during this market decline. We've kept our subscribers safe. If that's something you're interested in and learning how to beat the market on a day-to-day basis, come visit us at TrendLizard.com. Have a great day. We'll talk to you soon.